Let me start with a real example. In February 2024, a principal engineer at Meta received an offer letter showing $500K in total compensation. Base salary $250K, sign-on bonus $100K, annual equity grant $120K, performance bonus target $30K. On paper, it looked perfect. But when she dug deeper with a compensation advisor, she discovered something shocking. She was actually looking at a $50K annual drag that wasn't advertised anywhere in the offer. Here's what the offer letter didn't make obvious. That $120K annual equity grant, it wasn't all vesting equally. Meta structures principal packages with a front-loaded signing bonus but back-loaded equity. The first 2 years, she'd receive $80K per year in equity. Years 3 through 4, $120K per year. Years 5 through 6, $150K per year. And here's the kicker, there's a performance cliff at year 6. If she leaves before completing year 6, she forfeits any equity that hasn't vested. At year 5 and 11 months, she walks away from $75K in unvested stock. This isn't unique to Meta, it's the industry standard. Apple uses nearly identical structures. Principal software engineer offer I analyzed from Apple in 2023 showed $300K base, $150K signing bonus, $140K annual equity. But the equity had a 3-year cliff with 25% vesting at each anniversary. Then an additional cliff at year 6 where an additional $50K bonus only vests if you're still employed. Google uses what they call GSUs with refresh cycles. They grant you stock. But every 2 years, if your performance rating drops below meets expectations, they don't grant the refresh, effectively clawing back $40-60K you were counting on. Let me walk you through exactly how this works using a real case study from a principal engineer at Google named David. David negotiated a $520K package in 2019. Here's how it broke down. Base, $275K signing bonus, $125K annual GSU grant, $120K vesting quarterly over 4 years annual performance bonus, target $30K paid in stock, not cash. On surface level, that adds up to $520K. But here's what the offer letter buried in footnotes. The GSU grants have a continuation of service clause. If David left Google before vesting completion, he'd forfeit all unvested shares. Additionally, his annual $30K performance bonus was only guaranteed in years 1-3. In years 4-6, it became at the discretion of management, meaning they could reduce it to $15K, or eliminate it entirely if they claimed performance wasn't meeting their new bar. David stayed at Google for 6 years. During that time, he received about $120K per year in equity. But here's the math everyone misses. If he'd left in year 4, he would have forfeited $180K in unvested equity. 3 remaining years times $60K per year that hadn't yet vested. That's not a $500K job, that's a $350K job if you leave early, with a $150K exit tax. Now let's talk about the 3 invisible benefits cliffs that create this $50K annual drag. Cliff 1, the equity vesting acceleration cliff ***. Tech companies structure equity grants with what they call acceleration schedules. Here's how it works. Your first equity grant vests over 4 years. But your second grant, which starts in year 2, also vests over 4 years, meaning it doesn't fully vest until year 6. This creates a staggered vesting structure where your total compensation in years 1-3 is actually 40% lower than advertised. But your compensation in years 5-7 is 60% higher than advertised. A principal engineer at Apple shared their numbers with me in confidence. Their offer said $480K total comp. But breaking it down, years 1-2, actual compensation was $340K. They were only vesting 25% of each year's grant per year. Years 3-4, actual compensation was $420K. Years 5-6, actual compensation was $580K. The company knew exactly what they were doing. By front-loading your salary and signing bonus, they make the offer sound bigger than it is. Then they backload the equity to create what researchers call golden handcuffs. The longer you stay, the more valuable it becomes to stay longer. If this principal engineer left in year 3, she'd walk away having made only $340K plus $340K plus $420K equals $1M over 3 years. But she was told she'd make $144M, $480K times 3. That's a $340K difference from what was advertised. And the company was betting she wouldn't notice until she was already emotionally invested. Cliff 2, the performance bonus structure cliff ***. This is where it gets really sneaky. Performance bonuses aren't guaranteed, they're targets. A principal engineer's offer from Meta in 2023 promised a $40K target bonus. But here's what most engineers don't understand, that $40K is only paid if 1. The company has a profitable quarter, defined however they want to. Your manager rates you as meets or exceeds expectations. 3. Your organization hasn't been through a restructuring. 4. You were employed for the full bonus cycle in 2022-2023. Meta cut bonuses by 30-50% for principal engineers, saying economic conditions required it. Engineers who'd planned for $40K in their budget suddenly had $14-28K. Over a 6-year career, that's a $72-156K difference from what was advertised. Google's approach is slightly different but equally effective. They give you your GSU grant upfront, let's say $120K per year, but they also have what's called a GSU refresh cycle, every 2 years. If your rating is below meets expectations, instead of refreshing your GSU grant at the full $120K, they reduce it to $60K or eliminate it entirely. A principal engineer who got 2 bad ratings across a 6-year span could lose $240K in refreshes, money they were told would be coming. Apple uses a hybrid approach. They guarantee your first 3 years of equity, but in years 4 through 6, equity grants become subject to board approval. Technically, they could reduce them. In practice, during the 2023 reorganization, they reduced them by 15-25% for many principal engineers, calling it a market correction. Cliff 3. The equity grant cessation cliff. Here's the most brutal one. Once you reach year 6 or 7 at Meta, Google, or Apple, something changes. Your equity grants stop accelerating. You hit a ceiling. A principal engineer who'd been receiving $150K in annual equity grants in years 5-6 suddenly receives $80K in year 7. Why? Because the company assumes you're maximally vested by year 7. They've locked you in for 6 years, and now they can reduce compensation for anyone who stayed. If you leave, you've already committed 6 years, so you're unlikely to leave. If you stay, you're staying at lower comp than you negotiated. A former principal at Google called this the 6-year trap. Her offer promised $120K annual equity grants. In years 1-4, she received exactly that. But in year 5, her equity package was refreshed and they reduced her annual grant to $85K, saying you're now maximally leveraged in your existing grants. The company had structured it so that by year 6, when all her original grants were vested, she'd receive a lower refresh grant. If she stayed in year 7, compensation was $460K instead of $500K, $40K annual cut just for staying. Now here's where it gets interesting. The counterargument tech companies would make. They'd say, look, we're investing in your long-term growth. The vesting schedule ensures commitment and mutual investment in your future. Plus, if you stay 6 years, you're making $540K instead of $480K in those years. That's a raise. Technically true, but it's conditional truth. You only get that raise if you stay. If you want to join a startup, take a sabbatical, move to a different industry, or transition to venture capital, something that many principal engineers do in their mid-career, you forfeit it. The company has tied your financial upside to geographic, organizational, and career proximity. Let me give you a real-world example of what this costs. A principal engineer at Meta took an offer in 2018 showing $480K total comp. She planned to stay 6 years and then transition to a startup. Over 6 years, her compensation trajectory was: year 1, $380K actual year 2, $410K actual year 3, $450K actual year 4, $490K actual year 5, $520K actual year 6, $550K actual total, $2, 8M over 6 years. But here's the reality. At the end of year 5, she got an amazing offer from a startup to be their VP of engineering. It was a $300K salary but significant equity upside. She calculated, if I stay 1 more year at Meta, I make $550K. If I leave now and the startup succeeds, I could make millions. If it fails, I make $300K. But here's the trap. She'd forfeit $180K in unvested equity at Meta by leaving 3 remaining years of equity that hadn't vested yet. The effective cost of leaving was actually $480K, $300K new salary minus the $180K opportunity cost. That was an unwinnable equation. She stayed the 6th year. The startup opportunity passed. The $5M plus outcome she missed is incalculable. Now, the questions you need to ask before you sign any principal engineer offer. Ask these 3 questions. Question 1. What percentage of my total compensation vests in each year? Ask them to build a table. Don't accept vague language like annual equity grants over 4 years. Make them show you the math. Year 1, what percentage of my total advertised $500K actually vests? If they say 70%, you have a $50K annual drag. That's information you can negotiate. When a principal engineer at Apple asked this in 2024, Apple had to admit their $500K package was actually only 68% paid in year 1. The engineer negotiated a $50K signing bonus increase to compensate. That single question saved them $50K. Question 2. Are bonuses guaranteed or at will, and what percentage of principal engineers hit bonus targets in the last 3 years? If they say bonuses are targets. Get historical data. They should have it. If more than 10% of principal engineers missed bonus in the last 3 years, your effective compensation is lower than advertised. You can ask them to either guarantee the bonus, increase your base salary, or add equity to compensate. One principal at Google got them to provide this data. They admitted only 72% of principal engineers hit their full bonus target in 2022. She negotiated base salary up $30K instead of relying on a bonus. Question 3. Can you show me the equity grant refresh cycle and what the refresh looks like in year 6-8? This is where most engineers get trapped. They need to see the refresh. If year 7's refresh is 20% lower than year 6's grant, you now understand the long-term structure. You can negotiate a guarantee that refreshes maintain a minimum level, or you can plan your exit accordingly. The meta lesson here.